Hello, everyone. Welcome to Data and AI Live, wherever you are in the world. I know we've got people from all corners today, so thank you for logging in. Today, we're going to be talking about how AI is forcing private equity to rethink underwriting operations and portfolio strategy with our guest, Christian Karam, and I'll intro Christian shortly. But just a few bits for housekeeping. As I always say, we are live, so if anything goes wrong or the stream cuts out, many apologies. These things sometimes happen, but all part of the fun. Just stick with us and bear with us. And also, because we're live, we're fully interactive as well. So you're watching on LinkedIn, you'll see the comments down below. That's your opportunity to ask any questions that you have. Please ask those questions at any time during the session. Some of them we may deal with during as we go through. The majority we'll do a Q&A at the end, and we will definitely endeavour to answer all questions. So yeah, please, any questions, ask them as soon as they come into your head in the comments box down below. Guest today is Christian Karam, as I say, and I'll bring Christian in now. Hi, Christian. How are you?
Doing well. Thank you for being here. Appreciate it. Yeah.
Oh, no, thank you. Thank you for taking the time. To intro Christian to everyone, Christian's an operating advisor working at the intersection of private equity, tech and AI transformation. He's an advisor to multiple tier one PE firms. He's an investor himself, and he also sits on the board of a number of PE-backed portfolio companies. In his former professional life, he worked at Interpol, and then for a number of years as a special advisor to UBS Investment Bank on cyber, digital, data, AI investments. One of the reasons why I wanted to get him on was that, unlike a lot of people in private equity, his kind of mindset is that AI is far more than just a tool to optimize for PE firms, but rather it's a fundamental shift in the way PE firms operate, and that is kind of largely what our conversation is going to be about today. So, Christian, thanks very much for coming on again, and let's dive straight into it. And I don't know if this is too broad a question to start with, but how should private equity firms be thinking about AI in your view?
It is a broad question, and it's a very long question. I think also we're probably not going to get to the bottom of it today. But the reality is, look, it's been now 3 years that we're going through quite a lot of different motions with AI in the market, right? And very early on, I think everybody latched onto the idea of AI as a great opportunity for transformation and this technology, etc. I always go back to the idea that what's being proven in the last 3 years is that AI is probably more of a disruption force for the cash flow and business models than it is effectively just a tooling and technology conversation, right? There's undeniably a big component of technology disruption here, but for private equity specifically, it is about understanding the structural shifts around how businesses are creating value, how industries are going to be shaped, and effectively how competitive advantage is going to be, built all over again. And I think most of the market is still trying to figure out that question. Some private equity firms have really built frameworks to kind of start scoping that and get some answers, especially if there are specialist funds in certain areas. But others are still looking for the North Star as to what does that look like and how that's going to be. I tend to simplify the two parts. One, we're entering into an era where you have to have an inward strategy for the private equity itself, where you focus on what does AI mean to you, an underwriting framework, the creation of new roles within the PE, new capabilities, changing how you look at assets, how you operate assets, how you think about assets. And then the second part is the portfolio specifically, how you basically want to interact with the portfolio, how you want to restructure the portfolio, how you want to engage with the companies and the assets in the portfolio, and then eventually how to navigate them towards the best exit premium that you potentially can get. Because at the end of the day, people still feel like they're navigating within the AI devaluation risk theme, but this is about operating towards excellence and the highest premium possible and the highest exit possible for these assets at the end of the day.
Yeah, and we'll touch on a number of those topics as we go through today, but I guess a good place to start is you talk about, and I know we've talked about offline, the sort of AI native PE operating model a lot, and perhaps there's not many, if any, PE firms that are there yet. But what does the AI native private equity operating model look like?
It's effectively, look, I mean, the most important part, there are 3, 4, 5 pieces that are important to mention here, right? And let's start with maybe the inward lens, focusing more on like what does it mean for the PE, and then we can talk later on about what does it mean for the portfolio itself. The biggest change that probably we're noticing right now is that there's somewhat a capability that is being created in the middle between the investing team, the deal team, and then the operations team, right? And while value creation operations have always existed, they've been focused on themes like, cost optimization, enabling go-to-market sales, playbooks, all that sort of stuff. The AI theme is kind of forcing a little bit more, a bit of a polymath thinking in between. So somebody who can really kind of work with the deal team on understanding the investable themes, where does the sector heading? What does it mean? Where is the disruption for that specific industry? How do you underwrite an asset 3 years from now if these things are going to happen, right? That technical component translation into what does it mean for business economics, right? And is this business model underwritable in its current form, or very much likely where is it going to be evolving? So a framework for understanding how to underwrite this asset, what are the structural things that you're able to accept, right, from this asset and build on top. And then the operations team as well coming in. Of course, the existing operations playbooks are going to remain as they are, and they're going to be augmented with AI, but there will be new set of playbooks that have been created. So for example, moat reinforcement, data advantages, creating new forms of moats and leverages beyond just like regulatory barriers, and the things that are important still remain key for the industry. But at the end of the day, there's going to be a new generation of moats that are going to be created to underwrite those new business models that are going to be there. And then within that, you can imagine there's going to be new roles to be created. So there's going to be the central team, potentially like this polymath function that's coming in the middle, which we call an investing and operating capability, merged together. This could be both, experts or AI, right? And you're already seeing quite a lot of initiatives. I've been involved in several initiatives where I've been building, obviously, for these firms, like the structure of their backend tooling of how they want to be able to screen assets, think about assets, extract the DNA of what they're looking at, build a business model catalog, a library of this where they can do hypotheticals, simulations, all that sort of stuff. The native operation of the inward team. And then from there on, going in more towards defining what their playbooks are going to look like, refreshing their playbooks towards the market a little bit more differently there.
Yeah. And let me pick up on a few things that you said there, because there's a few really interesting bits. Data advantages and moats. What I don't know if you can give any specific examples of this or not, or at the very least talk at a high level, but what are some of the sort of the data advantages that investors and these new teams should be looking out for when doing diligence or underwriting a potential new acquisition?
There are some recurrent areas that are coming up, right? And it depends if it's a service asset or if it's, for example, a software asset. Like there are different categories. The things, if I would have to simplify them broadly, they're going to come down to technology parity, right? Being able to understand whether you can replicate that technology with less amount of cash, short period of time, right? Or a potential collision course with frontier players that are building technology, entering new verticals. So there's a framework for that, 40 different dimensions to assess whether you're structurally exposed, and if somebody can rebuild your business with $5 million and 3 subscriptions of Claude, right, in the back pocket. What's actually interesting in that specific point is that most of the time, the answer is maybe. It's never a yes, an absolute yes. And this might create a sentiment of defensibility, but the reality is for the next buyer, there's a perception that this asset is rebuildable or can be potentially eroded, right? And so we're not dealing anymore with factual reality. We're dealing with the perception of what people think this asset is and what this asset is supposed to be doing. And I think that's very important to note given the current sentiment about repricing assets and software and all that sort of stuff. And we can talk about it a little bit more. But the outside in view matters now a lot more than it was before. So you have the technology parity assessment, you have the data advantage assessment. And the biggest problem with data advantage is that people say, well, we have data and data is proprietary. That's not enough anymore. Now you have to demonstrate that you're doing something with that data. And that data is going through an engine or a process that is proprietary and creating new data. So therefore, you're the only one in the world that potentially is sitting on that data, which creates this continuity of your business model, and it can compound over time. That is underwritable. Just data on its own that is sitting is not valuable. It is still interesting, but it's difficult to really anchor a thesis on that at the end of the day. And then you have network effects, right? So sometimes businesses don't have data, but they have scale, they have network effects, they're able to extract metadata from their interactions with their customers. From doing 30 years of business, they have special know-how that is difficult to replicate. There's special access that is difficult to replicate, right? And therefore, these also become very interesting advantages to be built around, because the business might have one or two modes or several modes, but that gives you as well as an investor the idea of what can I go and acquire next to it? How can I supercharge this potential vehicle into something else? How can I use AI to replicate certain advantages and build them and then build towards a larger, bigger, more impressive asset in the market? You also have obviously distribution and regulatory. But I always caution, like, distribution is very hard. Yes, businesses have built like access to distribution, but distribution and regulatory are time bound, right? So generally, if you're being a bit aggressive on trying to underwrite an idea, you would kind of want to discount them, because you want to think about, if these did not exist, like what's the worst case possible that potentially to kind of think about, like the base case for this asset, like what more can be done with it, what can be built around it. But yeah, these are kind of like the 5 principles, but there's obviously a lot more that go into the more granularity, but we are effectively in this momentum where right now everybody's kind of circling around regular themes and then applying their own lens around it.
And on your first point, so it's not enough just to be able to demonstrate the data you've got. You must be doing something with that, which in reality, but also that's going to then help the perception from an investment perspective as well.
Yeah, the perception topic. So look, one of the core things that has happened with AI in the market is that we are caught in what we call the value perception gap, right? So let's say you're a software company doing payroll and invoicing, something like that, right? There's plenty of them in the market. Some of them are very respectable companies with half a billion of revenue plus. And they have their dominance in the market. They do their job excellently well. The problem right now in the market is that the customer, who's the end buyer, may perceive that the workflow that this company's the workflow that is delivering a service, right, through this company may be too simplistic and could be replicated, or in modern terms, like vibe coded with an AI solution.
Yeah.
I really doubt that, and we have a very clear viewpoint on this. Like, nobody's going to be vibe coding their payroll solutions tomorrow. That's not going to happen. Trust has a very important element in the stack of the enterprise. But the reality is, the fact that they perceive that is competing with a $20 subscription in your phone is a problem by itself. And so for a lot of companies, we go back to assess the pricing structure, how they're interacting, and as well, what are they leading with in terms of storyline to their customers. So I'll give you an idea. Let's say you're doing contract lifecycle management for a customer. They perceive you as executing the contract lifecycle management, the execution of this contract and all the small little workflows around it, etc. And they'll say, well, I can use ChatGPT to do this, so why do I need you? What we've done is look at, like, effectively, maybe what we should be promoting is the fact that this business has a network effect, right? And that effectively everybody sends their contracts to this business, and they can benchmark contracts, and they can tell you as a customer that this contract is potentially 30% more expensive than what your peers are paying for the same service that you're getting. And you've shifted something that used to be a feature but it became a primary differentiator in the storytelling as to why you need to do business with me, right? And then you start building on other advantages to grow the business in different directions. So execution is commoditizing, and you have to look at the structural areas that are pulling you towards a different kind of business model and story to tell to the customer there. There is no like repeatable answer here everywhere, but there's a structured like way of thinking about how do we reposition this asset given the value perception gap and what's happening in the market.
Yeah, because I guess there's something you said earlier about $5 million and three Claude subscriptions. I guess if you look at any business through that prism, you've suddenly got a value perception gap. So it's shifting that story, or coming up with a new story, I guess.
It's true. The challenge fundamentally is that right now it is good to apply a very aggressive outside-in view on an asset. So, when I do my assessment, I try to, as much as possible, to kind of decompose a company to the first order principles and go and say, well, this company is this, but you could also think from the next buyer perspective, if they're really trying to poke holes in this, it's disguised as that, right? And then you stress test really effectively between the marketing and the real play where they are, even to the point, actually part of the assessment is looking at the revenue structure of the company. So this company could be running 60% of its revenue from this single product. That product line is eroding, is losing value. It's effectively easier to replicate. Therefore, you have 30% of your ARR exposed to a 18 to 24 months commoditization momentum in the market. And again, whether it's real and it actually happens, or there's a perception that it's going to happen, that has an impact, because it has an impact on what the next buyer is willing to pay for the asset itself. And here you go into, well, I need to make a move on that specific bucket of revenue. I'm going to go and buy another business, or I'm going to go develop a different kind of solution on top of that business to reinforce it and create a barrier and protect it and shield it. I have to say, it's just been a lot of that for the last 2 years, sitting down with CEOs and with private equity firms and like their companies, and kind of helping them guide through and understand through what are the moves that they should do to make sure that they are able to absorb the shock and have a winning strategy in very close corners right now, high friction close corners in those conversations.
Yeah, absolutely. And just to circle back, and we'll come on to, because we've already been talking for almost 20 minutes on this internal topic, and I'm sure we could for an hour if we had the time, but we'll move on to the portfolio side shortly for everyone. But I just wanted to circle back to something else that you touched on as well, which was new roles to be created within this new AI native operating model, which is obviously something close to my heart in my business, and I know will be to a lot of funds as well. And so how should funds be thinking about that? What do those new roles look like, and what are the skills?
There's definitely the emergence of this polymath role. It's sitting in between the investment team and then the operations team, right? The translation layer of like the new science of reinventing and redesigning business model and underwriting business model, right? There's kind of like a joint hub unit, where we call it. And in certain PEs, they're doing that, right? They're effectively going ahead. They're building this. This is a hybrid model, and they're really thinking very, very deeply about like the structure of how you even get the deal team to think more like as operators and vice versa. There's a lot of AI transformation offices conversation right now, right? I've probably seen I've probably designed 6, 7 of them over the last 2 years. I caution a lot around this, because there's a lot of there's a lot of oversimplification of the role of what the AI transformation office is and what it could be, and eventually it ends up being seen as just another technology transformation hub or a consulting team internally that just does use cases. And we'll speak about it more about like in the portfolio section, but it has to be seen as something that has a clear target for the, not just like activating interest in AI or building a couple of use cases here and there. It has to have its own playbooks that actually are EBITDA improvement margins, like specific areas are repeatable, but also areas that are not repeatable. So we tend to think about generally like 5 different pods: one for like revenue operations, one for like productivity operations, one for data and infrastructure, because having an asset that sits in a data infrastructure that looks stale and old and fragmented is the worst thing you can have when going through an exit process, right? Effectively, it tells you that you cannot achieve any of the other AI transformation if you're sitting in bad foundations. You have a reinvention pod where you're reinventing the business model of the firm aggressively if really that asset sits in unfortunately, a bit of a high risk zone. You have a workforce adoption plan, and that is extremely important. People tend to think so much about the tech and the use case, and they forget that you have to teach people how to use the AI, because that's the metric that's really going to change things, right? And this incredibly like unfocused on somehow for some reason. And talent operating partners are now getting into gears to kind of focus a lot more about what are the right metrics to activate people, to identify how to get them to use AI, and also how to build AI that's actually going to be used by individuals. We'll talk about that. And the last part is more around like the exit readiness playbook, because you can easily get confused by bringing forward deployed engineering teams between trying to build technology for operational excellence versus exit readiness. And these are two different things with vastly different proof points to the market. One of them is running in a cycle of 5 years. The other one has an infinite cycle of proof points that you can kind of work towards.
Yeah. And just to pick up on something there, and maybe I don't know if this is something we would talk about later, but how do you, in terms of AI adoption, internally, how would you advise funds measure that and track that? Are there certain KPIs or metrics they should be looking at, ones that they shouldn't, that are mistakes? What would your advice be there?
For the private equity funds themselves? Look, it's hard, right? I mean, the majority, even for corporates, it's the same story. I mean, the classic playbook everybody does is they buy licenses and they give it to everybody, and that fails, right? Immediately fails, right? I've implemented so many of these transformation plans right now. I'm of the opinion that prompt engineering is a risk for adoption, right? Because you're going to have people at different level of maturity that are able to prompt. And 15 years ago, we had somebody in the office that we Googled very well, and they still Google very well, and some others have not caught up to the same ability to Google things. So we're going to see the same thing all over here. I'm much more in favor, and this is going into the second part of our conversation on portfolio. I do believe in a very, very important part of succeeding at doing AI is not mixing between a CTO and a CPO. And I think the chief product officer, especially an inward-facing product officer, building in tools on the inside, will increase the adoption. Because what people want is an input-output engine. They don't need to deal with a chatbot. They don't want to be learning how to prompt. I said the other day, one of the assets I'm on board of, I said like in an hour-long training for one of the big AI companies and I was thinking, this is just not going to move the needle. You have to have the internal team build applications for pricing, right? Or for due diligence, or for this and that within like a methodology, a framework that is proprietary and anchored with it. And then people can use this stuff because the learning curve is a lot easier and more adaptable. And then you can monitor like metrics, how people are changing their behavior and kind of behaving towards that. Otherwise, just giving people licenses, the best thing you can get out of it is to identify who has a higher AI fluency and who is less engaged on AI, and that maybe gives you some talent management planning situations.
Yeah, I hear you. Well, let's we're kind of naturally segueing into portfolio strategy now anyway. So let's talk about that and focus externally. How should funds be thinking about portfolio strategy in the AI age?
Look, there is a cycle of the value creation, right? Which vastly remains the same. But like I said earlier, the structural reality assessment becomes so important, right? Giving a private equity and then their portfolio companies like a reality shot as to how is your asset perceived based on this risk of AI disruption or the business model erosion or whatever that may be, and then putting it under stress and showing the compression forces, the expansion forces is very important as a starting point. Then you go towards getting your internal AI team, as it be working the portfolio or the company itself, to do what we call the value creation design first, right? So like the things that work really that do not work is a use case approach to try to deploy AI, and that's as well for like large corporates, by the way. The use case approach, um, for me, is seen as a bit of a red flag, right? Because there's a high risk of a pilot trap. You get caught into something, you think you're doing it right, you do one or two, three use cases, there's a lot of overlap, and then you can't scale to 200 use cases, right?
Okay.
And so effectively here goes the plan of where do we need AI? What is the qualification for that business case? And here's where like the team on the PE side can really help the portfolio companies, that if we do change that specific lever, do we add additional 3% EBITDA towards that specific, revenue bucket? And it's that surgical work that has to be done, because everything else is a bit of science work, right? Science project work that's kind of happening where it's experimental, just to demonstrate some level of interest in ROI. But this has to be a much larger strategy with the mindset that we're going to automate 30%, 40% of the business, etc. There's actually even like an assessment that can be done around like the automation ceiling. Like before buying an asset, you can determine how much of that asset, what's the maximum potential of automation, rework that into plans for day one, and then make sure that they are fully financially aligned in performance uplift, margin improvement, story expansion, all of that sort of stuff. That is very important to do to avoid just doing things that don't add any value. Go to the transformation, implementation of it. That's the easy story these days, right? There's just a lot of that can be done, even with working with external forward deployed engineering teams or with internal teams as well. And then at the end of the day, preparing for the exit. The hardest part is to demonstrate. If you're trying to sell an asset today, probably this year is the last year where you can probably sell an asset with just an idea of what the AI potential for a business is. Going forward, you're going to have hard proof points. So knowing what are the data proof points to demonstrate that you've actually been employing AI and AI is working will become crucial to get validation on that story towards ramping up towards an exit dynamic. So here, it's kind of like reworking the metrics and also preparing the playbook for the next buyer to understand what more can be done with this asset, right? Around the potential of transformation and redesign of what they do. So that's one part around the transformation part. The other thing I'll say, highly overlooked, we're sometimes struggling and we're realizing we may not have the right leadership teams that understand the AI native approach inside of these portfolio companies, right? So
within the portfolios companies themselves.
Yeah. Like how do you know whether the CEO that you have is able to understand what AI's change or disruption to the asset and then to the structure of where they sit is? The CFO, the chief revenue officer. The difference between a CTO and CPO, like I said earlier, one of the biggest failures of AI implementation is the CTO is tasked with building AI, but they don't have a product first mindset, right? And so you're always building the right way, but you're not building for the solutions the business want, because the solutions keep changing and you're always kind of working on different changes in the market there. So it's important to kind of understand the archetypes of the new characteristics that you want to see in these leaders. Like a good example, if you're looking at a software asset for a CEO, one of the things I like to stress a lot is their willingness to cannibalize a part of the revenue. If they recognize that this revenue is eroding and has to fundamentally change, right? Taking the decision is a very, very bold decision. It requires a lot of conviction to say, I may not be growing in that potential revenue driver, but I'm going to put a plan to transform it to something else that's going to have much higher upside and much bigger potential and absorb the shock of devaluation for the future. If you're looking at a service asset, for example, at CEO, one of the things I really like to focus on is somebody who has a data instinct in a very data poor environment, right? So they're thinking not just like service and nickel and diming the customer with dollars, but can I find other ways of digitizing the business, creating a data fabric, creating those data modes, and then the network effect mode, and that gives you signals as to their thinking they're going in the right direction or not.
That's interesting. Any other ways? Because I guess that would be something that is high on the agenda of a lot of funds, but also that they may feel there's a knowledge gap in how they stress test those executives that are already in place. So any other tidbits, advice you can give on what you'd like to see from C-suite execs, and maybe not CPO and CTO. We'll come on to that shortly again in a minute, but
Yeah.
CEO, CFO, ways of stress testing them.
These individuals are just naturally highly motivated, right? I mean, and it's getting a lot better. Like right now in the market, almost every CEO and CFO, probably CEO more, have taken like some sort of AI course and just kind of went to study it. But they're very quick to understand what does it mean for them, what does it mean for the sector, the industry, right? Especially when these companies are flagship companies, right? Like they're effectively at the bleeding edge of what they do. Like they have access to information that allows them to reinvent the core. The challenge has always been balancing how it's running and transforming it. It's kind of like trying to upgrade a plane while it's flying, right? Like you don't want to rock the boat too much. At the same time, you want to make sure that the story for the investors is going the right direction and you're hitting the right milestones. So that's where we help a lot. We come in, from the PE side, really kind of sit down in bed with the company, work with the CEO on what is the business, what makes sense. You can't do everything. You're going to have to make decisions around those five bets, right? And why those bets make the most sense, right? And we use a lot of frameworks. So I built framework for PE firms on, for example, doing scenario planning and how to look at, for example, different hypotheses are going to have. There's a structured way of looking at like market triggers. They're going to lead to hypotheses, and these hypotheses will have against them like technology plans, pricing plans, bundling plans, positioning plans, etc. So you do a lot of that work, and then whenever the market evolves and those market triggers are being detected, then you know how to respond to them effectively, right? And this is in a co-agreement, obviously, in support between the value creation side and then the asset portfolio side at the same time.
Yeah.
I don't think this is a 3 to 5 year thing. I think this is just the nature of how things are going to be for a very long time.
Yeah, and something that's again close to my heart is AI value creation and executives doing AI value creation. I speak to private equity funds all the time, and often who are hiring these roles for the first time. And a lot of the time, what they ask for is a kind of, they want someone who's AI native CEO or who's been in the C-suite and who's AI native, because I think their fear is that hands-on keyboard data AI folks aren't going to have the commercial chops to sit in a room with the C-suite of their portfolio companies. In my experience, that individual doesn't really exist, or who's then technical enough. So how should they be thinking about hiring AI value creation experts to their ops or value creation teams? And what does that ideal profile look like in your view?
It is hard. It is a new archetype that's coming in shape. It's somebody, and you're right. Like I've seen a lot of PE funds revert back to, we're just going to hire somebody who's really, really great with like, it's been like in a big tech before, knows AI. Generally, even big banks have done so, and they just did not find synergies go quite well. A different culture, and effectively to be good at that role, you have to have an approach to be a bit of a polymath, high interest in business models, right? Like you're able to translate the technology disruption into a business model strategy and redesign. And you're buying somebody who's got like one very strong area in tech, but may not have the interest in the other domains. And then you have
equally,
the other side.
You can't just hire someone who's been a CEO or a great consultant who has no technical depth.
That's the other part, right? Like, so many of them revert back to consultants as well, and then consultants are able to ask the questions, but can they as well make sure that they're able to sit down and operate those assets? And so the answer is something in between, right? Somebody who's able to sit down, somebody who's got potentially years of expertise of operating, of running functions and capabilities, whose own budget, who will be able to execute, and has a high AI fluency and understanding of AI, and sit down and structurally kind of like build that approach, asking the right questions, be embedded into it. Look, private equity, at the end of the day, is evolving to become the science of prediction of what the best business models are going to look like, right? This becoming the engine of growth. Is we're betting on companies not to just make money on them, but to operate them to the best shape they could be, right? So you need people to think in that mindset, right? Like, how do I build a 3, 4, 5 year plan and then rework it and then hedge the risks, but always with the mindset that I can get it and maximize as much as I can of the capacities that we have around it there. So it's interesting. And I want to say, by the way, like, I don't believe like one person can do this for a PE. I think clearly what's happening is that there's potentially more like it's a team internally that's going to be leading more on that. And then maybe one person can probably put the structure around it. Like, for example, the underwriting framework, right? We've done a lot of work around like, how do we change underwriting? How we do screening? How do we look at valuation, right? And adjusted multiples for like assets. Every area has been disrupted and somebody used to lead it. And now you have this individual that with this polymath coming in and kind of augmenting their lens to understand what the impact is from the beginning to the end, including the kind of portfolio operations and value creation bit of it.
Yeah, no, absolutely. We're as anticipated, we're running way over time here, but it's an interesting conversation, so we're going to carry on. I just want to I want to touch back on that CPO CTO thing, because I think that is interesting, and I think it's something that's really relevant to going to be relevant to a lot of companies. Before I do, Christian and I are probably going to speak for about another, I don't know, 5 or 10 minutes, and then we any questions, please do ask them in the comments down below, because then we'll take any questions at the end. So yeah, if you do have any questions that you want to put to Christian, now is the time to do it. But so that the CTO CPO relationship conundrum, let's talk about that, because a lot of that relationship's important. A lot of companies, depending on the nature of the portfolio companies, but a lot of portfolio companies won't even have a CPO at this point. So just kind of unpack those two roles, what their relationship should be, and the outlook of both, if you're a company that's trying to do AI value creation or create value with AI.
And even more broadly, I think as just a role like the chief product officer has been cementing more and more across organizations. I think with AI, and I'll speak more from the corporates that I've been advising, because they've been a little bit ahead of the PE firms. Look, we've gone through 4 different waves of AI for the enterprise in one shape or form. Right, we're entering the 3rd agentic wave. There's been 2 of them already. There's been LLM apps at the beginning. There's been different kind of motions to market. The reasons why many of them are fading, one is because you're tasking bottom up the engineering team to automate their own walled garden for efficiency. Right. There's nobody that is quarterbacking the strategy of, if we do all this orchestrated effort, we move the organization from here to here. There's just a lot of tests. There's a lot of duplication of effort. There's a lot of burn, but very little is kind of driving ROI. And I know there's a lot of negativity around ROI with AI, but some companies are succeeding, and there's a reason for that. Right? It's strategy and discipline. And here's where you start having a bit of tension. And there's a lot of very respectable CTOs, and many of them are also, they're able to think like a CPO. But the CPO is somebody who owns the decision around what do we need to build, why we need to build it, what is the pain point in the market that we're trying to address, and then what is the revenue that is attached to it and how we're going to be approaching it. Right. So you're building from the beginning for the product market fit. You're building for the use case fit. Right. So the chances of moving the needle is much higher, right? And you're building for the psychology of the user is going to be adopting that, versus what you hear right now a lot is, oh, what's the workflow? Let me put it together. Let me try to automate the workflow. And then, one of the biggest things you'll see right now is that everybody has an SOP and a catalog they want to automate, right? But the SOP has been probably built in 2008, and the person who invented it disappeared. And I'll give you a real example. A person I know works for a big tech company, told me their renewal process for sending a quote, and they're losing customers because of that, requires around 70 buttons to be clicked. Why? Because the process itself is flawed, and they have so many approvals in the middle chain, and nobody even bothered questioning whether we need 15 different approvers in this process. Just because of management ego, everybody comes in, they want to add themselves into the whole CRM system, etc. And
Yeah.
so with that, nobody is kind of doing process intelligence and redesigning it. And mind you, a lot of that work is human process. Now we're retrofitting for agentic process. Like the machine does not work within the same process the human does. It can read 15,000 pages an hour. We cannot. So you have to reinvent stuff to create accelerators for the machine aligned with your business and your outcomes and what you want to achieve versus try to really kind of do a one-to-one shift of what you do versus what you have. If you look at right now, the companies that are really evolving at this, they're putting a target. They're saying for every dollar of human work, they're expecting to see a dollar of agent work, matching it to look at improving productivity, right? And
Mm.
these are the kind of things that have to change. And CTOs, and there again, there's great CTOs. I don't want to put everybody in the basket, but the archetype itself has just not been in this dynamic, exposed to that dynamic as much as the CPO, and therefore you're seeing a much higher success rate and ownership of driving change within the CPO
So
organization.
would it be fair to say, if you're an organization that doesn't have a CPO, if you want to put this work under the CTO, you would want to ensure that they've got a product first mindset, because otherwise,
Yeah,
you have situations like you described with 70 clicks to
yeah,
um,
and especially reinventing the business model, right? Because the CTO is not going to reinvent the business model, but also more than that, um, AI should be and there should be an ownership in AI with every single C level in the company, right? Not just like the CPO or the CTO and like certain board members, like the go-to person, like the scapegoat on this topic. Like this is fundamentally a redesign of is going to impact the finance function, the way the CFO does work, the way the CRO looks at like forecasting, churn management, customer success, the whole thing, like back to front, is being redesigned, is changing effectively how things are being done. So it is important to kind of know and to kind of like also make sure that you have the right people with the right strategy, with the right functions, right, and the right alignment, because it's very easy to, like I said, get caught in the pilot trap and just to create AI bloat in the organization. A lot of the same stuff overlapping that leads to nowhere.
yeah. Let's quickly finish off by because I wanted to come back to this and end with this, because I think and get your take on how LPs are thinking, because I guess
Mm.
ultimately they're the sort of or to some extent they're the protagonists in all of this, because a lot of the
Yeah.
pressure I think on funds is coming from LPs who are asking questions about what are you doing with AI. So in your view and from what you've seen, how are LPs thinking about this?
I do think so. Look, LPs, the initial reaction obviously is that they're very worried with the headlines around, AI devaluation risk for portfolio. Can we navigate some of these assets out of the, zombie swamp into success? Is it going to be some real big exposure with software repricing and potentially other sector repricing as well because of that motion? Um, the risk is real, right? And I think the response to it is to create this, risk frameworks, and PEs have been building that and communicating very actively about this. On the other side as well, you've seen some PEs announce partnerships with frontier labs and joint ventures and so on and so forth. And I think that is yet unclear what is the shape of it, like how that's going to work, how that's going to be really moving the needle. But it is effectively as well a very important sign for the LPs to see that something is being done with AI, right? Now, how I bring it back in my conversations with the PE firms on this is that this is not just a defensive play. This is an offensive play, right? LPs are going to back the PE firms that demonstrate that they really understand the operating model, like post AI disruption or embedding AI across every bit of the firm and across the portfolio. And it leads to two main areas. One, you want to bet on the company that has created a methodology of using AI and embedding it in the operating model that's going to get you the highest upside, right? The highest premiums, exit premiums possible. Because again, we're going back into not trying to do a passing grade, surviving this disruption era. It's about leveraging it to become the most impressive companies in the market that have succeeded at leveraging this technology. That's one. And if it's ever going to happen, it's going to first start with private equity firms. And the second part is about, at the end of the day, when you think about it a little bit more, it's changing the dynamics of the relationship. It's potentially being able to operate an asset into excellence and exit the asset in 4 years instead of 7 years, right? And getting those returns that you're looking for. Like that changes very much the ability of the positioning between APE and the LPs. And they're going to be looking and expecting that, because why not? And I'm seeing it in corporates, by the way. CEOs are walking the floor and saying, can you do this thing by Friday? Well, the answer is no, but then they do it by Friday. Well, then if everybody's able to move a 3 months deadline into a week's deadline, then effectively you're, at the larger view of it, you're looking at effectively a different kind of timeline, because the biggest risk that we have is that we are assuming revenue durability, right? And that's really what's being questioned a lot with all these innovation happening in the market, in the sector, right? We have to work with shorter timelines and see how much we can do in the shortest amount of time and possible time around it. The last part I'll say, although it's not a point, but I'll say, I do believe LPs are going to be looking at how private equity firms are also investing in the AI technology itself, and themselves become a compounding business, right? So when I work with PEs, the ability that we're now screening companies in AI technology systems that we've built, and the fact that we are creating this catalog of business models and depth, and we can look at like the ability to screen 10,000 companies a year in one shape or form, whether you invest in them or not is irrelevant, right? But the ability to have conclusions on them and how they operate and how they think, again, going back to my point, this is becoming rapidly the science of predicting and shaping to excellence, like business models, and then creating like winning assets in the market itself. And I think the LPs will be looking at that, because that is going to make a big differentiation between the ones that just execute and they're just going to go back and just do the older playbooks of just sitting there and then cutting costs and then throwing sales pipeline, versus the ones that are going to be able to do all these different creative options that potentially could open up different potential for the assets and then for the dedicated funds themselves.
Yeah, I think so. And I think LPs are going to become much more sophisticated about stress testing funds and GPs in the way they talk about this stuff as well, which they probably haven't been up until now, I think is fair.
And especially a lot of LPs themselves are investors, right? So they are potentially sovereigns, and they're the larger, and then they invest in these PE funds, right? So they're going to want to see them match what they are doing, and what they are building internally, right? So the game of leveling up is really
the story is going to have to be more than surface level moving forward, which potentially I think it has been until now, or for many. Mustn't generalize, but let's. We've got a question. We'll move on to Q&A now. We've got a question from Tim. Tim, thanks for your question. Much appreciated and nice to see you. And this kind of relates back to sort of AI native C-suite. Tim asked, there's a lot of discussion around the removal of each C-suite level role, CDOs, CPOs, CTOs, etc. Do you see more of an amalgamation of roles where multifaceted, talented execs are the next phase of the shape of organizations? Of course, as you say, there is a need for AI to be owned by each individual in the C-suite, but wouldn't that be the same for the responsibility of the generation of value from AI too? That's an interesting one. Thanks, Tim.
Yeah, it is, and yes, in some ways, I think probably we're a bit early, but we're going in that direction where, like I said, I used the term polymath 3 times today for a 4th time. It is effectively that we're seeing people becoming a little bit more jack of all trades. The time I spend with companies. In the morning, I could be thinking like the CEO. In the afternoon, I'm thinking like the CFO, and like you're cutting all the way from product to revenue to sales to all of that. And AI is kind of forcing everybody to kind of think in a unified, end-to-end way. Like there's no more these big hard lines that are set up there. It is true. One thing I'll say as well to Tim, something we haven't spoken a lot about, but more broadly as well. Recently, I've been doing this for a couple of assets. around the consolidation of roles internally, right? So the way you think of AI disruption to the workforce and to the leadership roles as well is that every company has a mission. There are roles that support that mission. These roles have goals. Goals are done with tasks, and tasks are delivered with skill sets. And AI is measured by skill sets. So effectively, the role is not disappearing. The role is eroding or shrinking as AI grows. And then you're looking fundamentally in those assessments at consolidation of roles inside of a company, rewriting job descriptions, and potentially expansion pathways for these roles into something else, right? But it's fascinating when we're going like those full HR scans and looking at like the structure of the company, and especially in middle management, how rapidly there's a consolidation of roles, and we're going into different kind of shaped organizations that are growing that. And C-suites eventually will have a bit of a redesign, reshape as it stands going forward with it as well.
Yeah, great question. Thanks, Tim. It really surfaced an important topic. Probably do a episode on that alone. We've got a question from Mayank. Oh, and just before we take Mayank's question, we've literally only got a few minutes now, everyone, before we log off. So any other questions, please get them in now for Christian. Mayank, thanks for your question. He asked, what does the usual timeline for a transformation look like? And how do you prove the value is achieved to PE management?
Yeah. The answer for the transformation timeline, if you have the chance to do it even before owning the asset, the pre-deal plan is baked in the beginning, that's even better. I think this is probably the best thing that's been happening in the last year and a half, is more PEs are actually building the transformation and pricing the transformation as part of the deal itself, right? So you know exactly how much you want to spend if you were to acquire that asset, and you know exactly, like I said, what is the automation ceiling. And the automation ceiling, it says if we execute those plans by the next 12 months, 18 months, we can add another 7% of EBITDA on, like, for example, the company itself, and then the revenue drivers, and we can change it, and we can eliminate that cost, and we can get X percentage of working capital back to the table. Transformation could be anywhere between rapid 5 months into certain areas, because especially when you're trying to sell an asset and you have 12 months, right? You may not be able to do everything. You have to decide what you want to do. And some of these could be multi-year transformations. There are certain assets where you can't just do something. You have to reinvent the whole business model. So it could be a 3-year journey to kind of like take it into the right direction. How to prove the value? It's all in the financial metrics at the end of the day, right? Make money, save money. Like that's the reason, the purpose of every company on earth is effectively make more money and save more money and then operate towards excellence, right? And I think this is the part of not getting caught up in those rabbit hole AI plans that are science project related, that don't really create any sort of like upside for the company at the end of the day. Landing it safely there.
Just on that, and you've mentioned that a couple of times, sort of phrase science project type.
Yeah.
Just unpack that a little bit. So how can people spot those type of projects that maybe might not be useful or create value in their own organizations?
I was looking at an asset 2 weeks ago, and there were 7 different transformation tracks with AI. Only one of them had quantified the financial savings and the margin improvement for that specific product line. Everything else was working with no specific target. It was based on technology would be great, and we think we should do that, but nobody was quarterbacking and steering the ship towards the target of what can we demonstrate as a proof point that we have improved in the company itself there. The other thing I'll add to it, by the way, is that not all AI efforts are priced by the market the same way. So a lot of work, for example, is on like SDLC, like trying to ship software faster. That's great. And I think it's important and it's a must-have. But there are also certain dynamics where you think about like the next buyer, the next acquirer is not going to tell you, oh, you've done SDLC well and you're shipping faster, therefore I'm going to give you a premium, and it's going to be a multiple expansion story here. They're going to say, well, we expect that because we're now in the middle of AI age, so it's already priced in. But if you don't have this operating excellence component here, it could potentially be seen as a drag, and it could potentially do some level of contraction towards the multiple itself. So it's very important to navigate and to understand what are the AI efforts that are really improving the story, what are the ones that have to become must-have, and kind of navigate the minimal base of like not being caught in just doing efforts that not going to land the story that you're looking for at the end of the day.
Yeah, good stuff. Thanks, Mike. Christian, we could talk for hours, I think, but alas, we've run out of time. So thank you very much again. Thanks everyone for who's been watching and listening to us. I hope it was valuable. Christian, thanks very much for your time and your insights. It's been really great. Where can people contact you or reach out to you if they'd like to?
I'm on LinkedIn as always, like everybody else. Yeah, but appreciate the time and the opportunity. It's always good to chat to you.
Yeah, likewise. Thank you, Christian, and thanks everyone. And we'll see you on the next one. Cheerio.
Great. Thank you again. Ciao.